A canary in the coal mine. That is the chilling phrase being whispered across Wall Street right now. It refers to a series of quiet, deliberate moves made by the one man whose actions can silence a trading floor, Warren Buffett. While the financial sector celebrates soaring profits and the markets dance near record highs, the Oracle of Omaha is methodically and quietly selling. He is dumping billions of dollars in shares of America's biggest banks, a strategic retreat that has analysts and seasoned investors deeply concerned. This isn't just portfolio rebalancing, it's a powerful nonverbal signal from the world's most closely watched investor that he believes turbulence is ahead. So what exactly does Buffett see that the rest of the world is missing? And why is he building a cash fortress while everyone else is still at the party? Today, we are going to dive deep into the multi-billion-dollar exits that have sent shockwaves through the global financial system. We will explore the eerie parallels between his current strategy and the moves he made just before the catastrophic 2008 financial crisis and the 2020 pandemic crash. And critically, we will reveal why other giants of finance, from JP Morgan's chief executive officer Jamie Dimon to the legendary bond king Bill Gross, are now following his lead and sounding their own alarms. This is the story of a silent warning, a massive pile of cash, and the growing fear that the American economy is heading towards a reckoning. The smartest money in the room is making its move, and it suggests a storm is brewing on the horizon. During the first half of 2025, the world watched as Warren Buffett's legendary investment vehicle, Berkshire Hathaway, systematically reduced its exposure to the very heart of the American economy, its banks. The scale of this divestment is staggering. We're talking about more than $3.2 billion in shares tied directly to the banking industry being sold off in a matter of months. Let's break down these moves, because the specifics are what make this so alarming. First, there was the complete liquidation of their stake in Citigroup, a clean $1 billion exit. This wasn't a trim, it was a total abandonment of one of the nation's largest financial institutions. Then came the significant reduction in their Bank of America holdings, with Buffett cashing out $2 billion worth of shares. He also began trimming his position in Capital One, another signal of his cooling sentiment. These moves, all meticulously disclosed in mandatory SEC filings and confirmed by analysts who track Berkshire's portfolio like hawks, paint an unmistakable picture. Larry Cunningham, a director at the John L. Weinberg Center for Corporate Governance, put it bluntly to the Telegraph, stating, "Berkshire has clearly been reducing its exposure to U.S. bank stocks." That activity signals a cautious or even bearish outlook on banking. What makes this so profoundly unsettling is the timing. This isn't happening during a period of panic or poor performance. Quite the opposite. This divestment comes at a moment of incredible, seemingly robust profitability in the sector. In the very same period, Goldman Sachs reported a massive 22% jump in quarterly earnings. Citigroup, the very bank Buffett just abandoned, saw its profits surge by an incredible 25%. Both of these results wildly beat Wall Street's expectations, and the KBW Nasdaq Bank Index, a key benchmark for the sector, is flirting with all-time record highs. But this surface-level profitability hides a deeper, more structural vulnerability that Buffett, with his forensic eye for balance sheets, undoubtedly sees. The rapid rise in interest rates over the past couple of years has created a ticking time bomb on the balance sheets of many banks in the form of massive unrealized losses on their bond portfolios. These are government bonds and other safe assets that banks bought when rates were low, which are now worth significantly less. This was the exact issue that triggered the collapse of Silicon Valley Bank and others. While the mega banks are far better capitalized, the underlying risk hasn't vanished. A prolonged period of high rates or a sudden economic shock could force these paper losses to become real, devastating losses. Buffett is likely looking at this underlying fragility and deciding that the risk-reward ratio is no longer favorable, no matter what the quarterly earnings reports say. This isn't the first time we've seen this playbook. Buffett's legacy is built not just on the billions he has made, but on the catastrophic crashes he has skillfully avoided. Years before the 2008 collapse, he famously warned that complex derivatives were financial weapons of mass destruction. a prophecy that proved devastatingly accurate. And in the months leading up to the COVID crash in early 2020, what was Buffett doing? The exact same thing he is doing now, quietly accumulating a mountain of cash and reducing his exposure to vulnerable sectors. It's a pattern honed over 7 decades of investing. While markets are often driven by irrational exuberance, Buffett's moves are cold, calculated decisions based on numbers, patterns, and a gut instinct that is proven right time and time again. When he sells into a booming market, it's not a sign of panic, it's a sign of profound discipline. He is sending a message that the current party on Wall Street is not sustainable. The music is about to stop. It's a chillingly consistent strategy, and it's why his current moves are being treated not as a simple portfolio adjustment, but as a dire economic forecast. It's one thing to sell stocks, but it's another thing entirely to see where that money is going. Or, in Buffett's case, where it isn't going. As he divests from banks, he is simultaneously building one of the largest corporate cash reserves in history. Berkshire Hathaway's cash position has now swelled to exceed an unbelievable $350 billion. Let that number sink in. $350 billion, sitting on the sidelines, held in the safest, most liquid assets. This isn't dead money. This is a war chest, an amount of capital larger than the entire gross domestic product of many countries. It's dry powder being kept ready for the aftermath of a storm. Buffett is patiently waiting for the inevitable downturn when asset prices collapse, and he can step in as the buyer of last resort, scooping up world-class companies for pennies on the dollar. He's not just avoiding a crash, he's preparing to profit from it. And the small portion of capital he is deploying tells the other half of the story. He's repositioning Berkshire's portfolio away from cyclical financial stocks and toward 2 specific sectors: energy and consumer staples. We've seen fresh investments into companies like Occidental Petroleum and Constellation Brands. These are classic defensive plays. No matter how tight household budgets get, people still need to buy food, beverages, and basic goods from these companies. They still need fuel for their cars and energy for their homes. These are not discretionary purchases, they are necessities, making their revenue streams far more stable during a recession. The strategy is crystal clear: reduce risk, hoard cash, and make small, targeted bets on stability. It's a textbook defensive maneuver from the grandmaster of investing. If you're finding this breakdown of Buffett's strategy as fascinating as we do, please take a moment to hit that like button. It really helps us understand what content you want to see more of. Now, if this were just a story about one legendary, albeit aging, investor, it might be dismissed as a cautious quirk. But it's not. The alarm bells Buffett is ringing are being echoed by some of the most powerful figures on Wall Street. Take Jamie Dimon, the formidable chief executive officer of JP Morgan Chase, the largest bank in the United States. In April, Dimon sold $31.5 million of his own company's stock. This followed a much larger $125 million sale in 2024. Why is this so significant? Because it was his first personal sell-off of JP Morgan stock since he became CEO all the way back in 2005. For nearly 2 decades, through the depths of the 2008 Great Financial Crisis, the European sovereign debt crisis, the trade wars, and a global pandemic, Jamie Dimon held firm, never selling a single share. His confidence in his own institution was absolute. That he has chosen this moment, a time of apparent strength, to begin cashing out is perhaps the most potent insider signal the market has seen in years. When the captain of the biggest ship in the fleet starts quietly selling his personal stake, it's a signal that cannot be ignored. And these insiders are not selling in a vacuum. They are reacting to a gathering storm of economic and political headwinds that are becoming impossible to overlook. The economic data is starting to paint a worrying picture. United States inflation, a persistent thorn in the side of the economy, hit 2.7% in June. In response, the Federal Reserve, America's central bank, has been forced to slash its growth forecasts for 2025, not once, but twice, dropping its projection from a healthy 2.1% all the way down to a sluggish 1.4%. These aren't just abstract numbers. They are a direct signal from the central bank that it anticipates weakening consumer demand and a significant economic slowdown in the second half of the year. Kambiz Kazemi, the chief investment officer at Validus Risk Management, identified the key vulnerability, stating, "The big red flag is going to be consumption. If unemployment goes up and consumer spending drops, it triggers a feedback loop through the entire borrowing ecosystem. This is the domino effect that investors like Buffett fear. Higher inflation could force long-term interest rates up, which in turn leads to a cascade of negative consequences. Rising loan defaults for both individuals and corporations, a sharp decline in merger and acquisition activity, which banks rely on for fees, and severe stress on the massive bond portfolios that banks are required to hold. It's a vicious cycle that can quickly spiral out of control, turning record profits into devastating losses. On top of this fragile economic situation, a new layer of profound uncertainty has been injected into the markets: political volatility. The revival of aggressive trade wars under the Trump administration has already created significant market swings. But the bigger fear on Wall Street revolves around the administration's increasingly confrontational stance toward the Federal Reserve, an institution whose independence is considered the bedrock of a stable economy. President Trump's escalating public threats to remove Federal Reserve Chairman Jerome Powell have rattled investors and bank chief executive officers alike. This isn't a partisan issue, it's a stability issue. The independence of the central bank is not a technicality, it is the fundamental pillar of trust that underpins the value of the US dollar and the stability of the global financial system. The idea of a president directly dictating interest rate policy to serve short-term political goals is the stuff of nightmares for institutional investors. It would introduce a level of political risk and unpredictability previously associated with unstable emerging markets, not the world's reserve currency. It would be the financial equivalent of pulling the pin on a grenade and hoping it doesn't go off. As one expert noted, uncertainty around tariffs, and more generally, uncertainty about most subjects, the way the administration is running things, is going to be slowly eroding the trust in the system. The reality has to catch up. This confluence of economic red flags and political threats has not gone unnoticed by other market legends. Bill Gross, the co-founder of PIMCO and a man widely revered as the Bond King, recently took to the social media platform X to issue his own stark warning. He wrote, "Investors, wake up. I, for one, am moving defensively. More cash, buying value with 4 to 5% dividend yields, and an emphasis on non-US. This is a powerful echo of Buffett's strategy. More cash, a focus on stable, dividend-paying companies." And that final piece of advice, an emphasis on non-US, is particularly telling. It's a direct statement that the confluence of risks in America, stubborn inflation, a potential consumer slowdown, and unprecedented political pressure on the central bank, makes the US market a less attractive place for capital. He is advocating for geographic diversification as a shield against what he perceives as a uniquely American storm cloud. When both the king of stocks and the king of bonds are giving the same advice to run for cover, it's a moment of rare and terrifying consensus. So where does this leave us? While it's true that Berkshire Hathaway still maintains significant exposure to the financial sector, including a 16.4% stake in American Express and a 10.1% holding in Bank of America, the trajectory is undeniable. The firm is systematically reallocating its capital away from risk and toward sectors known for their resilience in downturns. The Oracle of Omaha, the man who built a $100 billion fortune by being greedy when others are fearful, is now being profoundly, historically fearful while others are still celebrating. We are watching a master at work, executing a quiet, defensive strategy in the face of what he perceives to be an unsustainable market propped up by shaky economic fundamentals and political turmoil. We'll be tracking every move and every new filing as this story develops, so make sure you are subscribed with notifications turned on so you don't miss our next crucial update. It's impossible to know the exact timing of what's to come, but the signals are flashing red. Buffett's moves, combined with the warnings from Dimon and Gross, form a powerful mosaic of caution from the very people who understand the financial system best. They are not just predicting rain, they are building an ark. The canary in the coal mine has stopped singing. The only question now is, who is listening?